Welcome everybody. How we doing? I'm doing just awesome. Couldn't be better, honestly. Nice. Yeah, I love doing this one. Most people use EMAs and SMAs, so it's always one of the early ones I do in my little series. Welcome everybody. We'll give it a few more minutes. Dude, that noise you make when you join Discord or when you join voice chat, Joe, sounds like I would imagine one of those Moai heads to sound like. Yeah, no, it doesn't sound like DMX. Welcome everybody. Like I said, we'll give it a few more minutes talking SMAs and EMAs tonight. Love talking these. And sometimes just reading what old Norvin is typing on trade floor is just too much to handle. TNT, let's get that breakout here in the next couple days. A little continuation would be nice. Maybe about Apple in today there, huh? That was a wild one. It's been that fun doing that addition. Oh, check square, yeah. SQ, huh? Well, bounced right where you'd hope to. It's basically the level to play right there. Might as well round it down to about that 90. I'm basically a dip buyer down into there, and then under there, you're probably looking, you should be looking to be short, would be my guess. But that is big. Yeah, I mean, you should definitely basically be a dip buyer down into that 90 no matter what. Or if you caught that today. Yeah, dip buyer down into 90 for sure. Wow, that chart actually looks pretty good. Probably giving up this little trend it's got. Yeah, but that's okay. Big breakouts will break out and consolidate. But yeah, if you feel a little sideways movement there for a couple of days, you know, a couple more dips down to 90 to make sure they want to hold it, and that thing could get to going. Or if it cracks over that 93, I mean, it'll very likely see these highs pretty quick, 94.30 up to 95, you know. So, but for now, dip by it down to 90. Nice one. And we'll just give it a couple more minutes, check a couple charts to start it out. Why not? PLTR. I mean, who knows where this thing's going? This is just uncharted waters. Pretty big rejection right there, huh? But this should be the little, this little consolidation zone is what everybody should have their eyes on. Again, dip buying all the way down to that 58.75, 60, 58.75 area is great. Obviously, you could have taken that short when we failed this previous all-time high today. I missed that. Would have been a nice one though. But as far as levels, oops, not a ton of levels that I'd care a lot about. We've just spent so little time here. There's just not a ton of data. But that's basically somewhere around there is what I'd have my eyes on. Now, I mean, obviously new all-time high, a little high there. Okay, give me 1 second. Check SPY 2. Remind me at the end of class if we got time, and we will try to check that out. Let's see. 1 second here. Okay, everybody, welcome. Happy to have you here, Dirty River. Going to be talking EMAs and SMAs tonight. Not going to be, we aren't going to get into the math. We aren't going to get into that kind of stuff. We're just going to talk about, some different ways to use them, as well as some different combos that I like to use. Everybody uses the 920 or 92150. So we're obviously going to talk that one tonight, but then we're going to talk about some of the, slightly less used combos, maybe some ways that I use them that other people don't. And then, just kind of how I use them to trade with, some of the things that they can represent, ideas that I have when we're around different ones. And so we're going to cover, we're going to start with SMAs. That's always what you should start with, at least in my opinion. And then we'll get into a few of the different EMA combos. I think we're going to cover 4 or 5 of them tonight. And I have different ones that I like, depending on, am I looking for a day trade? Am I looking for, quick volatile scalp that's either going to be, big percent win fast or very quick stop out. Some that I like to use for kind of longer term day trades, as well as some that I like to use for swing trades. And so, oh, we got Norvin in the house. Oh, nice. You're in. I didn't see that. You're in some calls on that on Square. I like that. I mean, I like that. I think stick with that trade just to pull it back up, show you what I would be watching personally. Really, this 89, 50, 90 zone. If you start to see weakness under there, there's a very good chance that we will see some more pullback. I, of course, won't be turning bearish on it. Nice strong chart. I'm assuming that it must have put up halfway decent earnings or, oh yeah, I mean, God, massive beat on earnings to be met by a big gap down. Gotta love that. But obviously they bought it back up. And so I like that trade. Yeah, good for you. And those hundreds, I probably would have gone closer to the money. That's just me. I don't like to play this because you have to think when we're at 90, you're over 10% out of the money, looking for that 100 move. And so I like to go a little bit closer. You will make more dollars on a smaller move. Of course, the contract will cost you more, but the return will be really nice on something like that. But nice one there. Yep, we got Norvin. Oh, I'm assuming those are all the EMAs you use. Yeah, I don't do that. I don't use all this. I think I use one of those ones you listed. 6, how we doing? Yeah, square. Nice one. Nice one. Yeah, so good eye there. Norvin, we are doing charts tonight, but maybe at the end we will. So, okay, to get back on track, sorry, I was catching up with the chat. I'm trying to do better with that. We're going to be talking EMAs, SMAs tonight, different combos that I like to use, things that I like to look for, things that I use, when we're trading around them. What are some ideas that I like to have? And so, the main ones that we are going to start with tonight are SMAs. And I love SMAs. I use them as frequently as I can. So they're an interesting one because I personally only use simple moving averages on longer time frames, 4 hours daily, weekly, and really mostly the daily and weekly. Those are the places that I'm concerned with simple moving averages. And for anybody who doesn't know, the two main types of moving averages, there's many more, are SMAs and EMAs. And so what those are, simple moving averages, that's what we're going to talk first. And then EMAs are exponential moving averages. And what the difference is and what a simple moving average is it's literally a simple average. So the main ones that I use, and I have them on my chart, we'll go to SPY. And then hopefully I got a blank one. Yeah, there we go. So we're going to go to SPY. The main ones that I use, and you can see them on my chart, dark blue is the 20, light blue is the 50, and then this kind of pinky salmony colored one is the 200. And so when we're talking about those numbers, what do we mean? A lot of people don't actually know what the moving averages represent. And so when you're talking about a simple moving average, what the number is, so like I said, this blue one is 20, and we're on the daily time frame. Like I said, I mostly use simple moving averages on the daily time frame. When we see 20, what that means is it is looking back 20 candles. And it doesn't, just depends on your time frame. Obviously, we're on the daily, so it's looking back over 20 days. The 50 simple moving averages is looking back over 50 days. The 200 obviously back over 200 days. And so, when we're looking at the 20, we're basically getting a month's worth of data. And so really simple rule of thumb is, if we're trading above the 20 simple moving averages, that means anybody who's been long for the last 20 days is net positive. If we're trading above the 50, anybody who's been long for the last 50 days, net positive. 200, obviously 200 days. So the better part of a year, 3/4 of the trading year, maybe a little bit more or less. And so that's what those are. Now, what is the math? So simple moving averages, you notice when you look at them, they're very smooth. They move much more fluid. And the reason that they move much more fluid is because of the math. And so we're only going to talk simple moving average math tonight. We aren't going to talk exponential moving average math. And we're talking it because it's simple. You take the close of the candle and then you add it. And so, if we have 20, if we're on the 20 SMA, this blue line, you take the close of 20 candles, add them all together, and divide by 20. That's it. That's all you do to figure out the simple moving average price. So why do we as traders care about them and how can we use them? The main way is kind of how I was just describing. You have, you don't want to, of course, have it be your only bias setter, but we know if we are spending most of our time above these moving averages, that obviously the market is bullish. If we zoom out, the market is bullish. If we're staying above these, we should really be remaining in dip buy mode. Of course, if the market is trending down like it was back in 2022, and you can see that was a very volatile year because the market really wasn't sure if it should be selling. And so they were trending down, but we had a lot of volatility, very big moves. So, they look a little bit less fluid, but still trading well below the 200, trading below the 20, trading below the 50. You know that the market is in a downtrend and you are, technically speaking, safer to be shorting bounces than you are to be buying dips. No denying there were some wonderful dip buying opportunities all through 2022. However, it was still a bear market, so you were fighting it. And so that is one of the best, and without getting very technical, that is one of the best things that we can use as traders, especially when it comes to simple moving averages. We can just look at those and take them at face value. And we're going to get into trading them here in a second, but take them at face value like that. And again, this is a extreme simplification. If the SMAs are pointed up and to the right, and we're spending most of our time above them, we're in a bull market, and you want to be, oh yeah, I'll repeat the SMA thing in 1 second. So you want to be buying dips. This is very obvious bull market activity. When you come back here, they're pointed down and to the right. So you obviously want to be shorting rips. That's the best thing we can do. So repeat the part for SMA. So SMA is simple moving average. And so if we're above them, like I just kind of described, you're generally speaking bullish. You of course don't want to just buy every red candle or anything like that, but overall the market is bullish. If we're below them, the market is bearish. Now I want to touch on the 200. So the 200 is huge. Everybody uses it. Day traders use it, you know, big time swing traders. I won't say hedge funds use simple moving averages because hedge funds are quite literally the data that simple moving averages are calculated on. You know, they're the volume in the market. The market makers, the algos, all of that, they're the volume in the market. So when we're saying, you know, hey, we're above the 20 SMA, that basically means that hedge funds are making 20. And so the 200 is huge. Everybody watches this. You'll even hear it as we, you know, as we start approaching it. You'll start to hear them. I mean, even the CNBC folks will talk 200 moving averages. They are really, really big. The 200 day, obviously a very, very big level. You know, generally it goes one of two ways. The first time we test it, we're almost always going to bounce, barring some bad news. We will get some sort of bounce. It's not always going to be $25, but we will get some sort of bounce. If we break below it, it's going to behave one of two ways. You are going to see some volatile selling for a couple days and will instantly bot back over it. You know, that's the common way the 200-day performs, because you have to think you've now relatively speaking, you've now given up 3/4 of a year worth of gains. It's not exactly true because it trends up, but you know that people are starting to sweat if the 200-day is breaking, because that's a big pullback. You can even see frequently we won't get all the way to it and you will get a bounce. The other way that the 200 goes, if you break it, do a couple of retests, market is, you know, providing the correct sentiment, you remain selling. You know, obviously it offered one of the nicest shorts of 2022 was that bounce back up to the 200-day. If you are consistently trading below it, there's a very high likelihood the market is going to see a pretty decent correction. You of course never know how much. You know, again, to come back, this is obviously the COVID sell down. So generally, if you're breaking the 200-day and you're actually going to sell below it, there is a reason for it. Very rarely will just a technical, you know, 5-10% correction in the market. You know, everybody turns bear mode on those, but those are just healthy for the market. It provides opportunity for buying, you know, things like that. If we're really selling below the 200-day, there's a very good chance that there is a reason for it. Again, right here, a lot of people don't know it, but there was the 2018 financial crisis. This was actually where the Fed attempted to increase rates. And when they did, obviously market sold, and then that was shot down and jobs were threatened. And so we were bought back off of that. But if we're trading below it, there is very, very likely a reason for us to be trading below it. So then that's the 200-day huge. The only other talk we're going to do about, you know, not technicals, just way to think about it, the 200 weekly SMA. All of the weekly SMAs will be massive levels. You can see it ultimately ended up basically marking the bottom on the 2022 bear market. And why is this one so important? And the main reason that it is so important is if you think about it, you know, as we discussed with SMAs, the 200s are based on 200 candles, whatever it is. So when you start talking about 200 weeks, you're now talking about, you know, 3.5 pushing 4 years of giving back gains, you know, and on your you know, trajectory up. So the 200 weekly, you don't spend time below it unless mayhem is happening. Obviously, you know, even during COVID, we only spent 4 weeks below it. Of course, that was massive QE that kind of helped us out there. But the 200 weekly, you don't tend to spend much time below it. Obviously, I guess I should even zoom us out a little bit. The last time that we really spent a good amount of time under the 200 weekly was obviously the 2008 financial crisis, which was huge. You know, I know a lot of people weren't alive for it or didn't experience it at all, but the 2008 financial crisis was huge. And you can see this is a weekly chart. We spent multiple years below the 200 weekly, justified, you know. Of course, we started seeing nice buy-in by that, you know, very beginning of 2009. But you know, nice bounce on the indices, still well below the 200 weekly. So to bring it all back around, how do we use these? And what are some trades we can take off of them? And How can we use them as traders? Well, my absolute favorite thing is basically the thing that we've been discussing. If we pull back to these SMAs, in my opinion, they instantly become the most important level on the chart. So if we're doing things, if we've broken above them and we're getting our first pullback to it, I'm a dip buyer. Any of these pullbacks close to it, I'm a dip buyer. Will you get blown out sometimes, like right here? Absolutely. However, we bounce back up to it. You can now short the bounce to it. And then again, you target these other SMAs. This is, of course, this was that unwind trade. So, it's a weird part in the market. But we want to be dip buyers as we pull into these SMAs. Even, I mean, down here, if you were a dip buyer here, you made money. You ultimately did, end up getting blown out, but this was leading into elections. So there was some mayhem there. And then again, dip buyers at this level. So that is my favorite way to use them. I will attempt dip buys at all of them. If we push down to the 200, I'm a heavy dip buyer at that point, And then why do I like them? Because you frequently don't get blown out super bad. There's of course going to be times, this one, looks, I mean, SPY took a big gap down. Eh, yeah, SPY took a big gap down, 3-4 buck gap down. So you got blown out. Good there. Generally speaking, you aren't going to have those big old blowouts. So that's how I love to use SMAs. The markets tend to track with them very well. You can use them on anything, and they work really well and will frequently be the most important level on the chart. I mean, even if we go back to, we had that 50% retrace of the election level. Well, right around there, and we'll now go into a shorter time frame. And of course, now we're looking at it, on a shorter time frame. And we had our level. This was our SMA that we had, at that point when we were trading right there. Look at how the dip buyers were rewarded every single time it was touched. And then I mean, you never know that you're going to run $15. You should assume you won't, but ultimately paid very, very nice. I'm of course not saying it was the SMA that caused that, but it was a really great place to be a dip buyer on the chart. And then again, everything that I just said, if the market is trending down or whatever stock you're using is trending down, I can't think of anything that's really trending down enough that it's probably actively trading below these. ARC finally took the breakout. I can't think of anything that's actively trading below its SMAs right now, bear market style. But you can do the exact opposite, buys up to them, very reasonable shorts when you are in a downtrending market. So that's SMAs. Like I said, mostly use them on the daily myself. Any questions on those? Let's see. Hopefully I answered your question, Excel. Yeah, I mean, Norman, yeah. Hopefully you were listening because that was basically what I described. That 200 is 9 times out of 10 the strongest level on the chart. Nah, I mean, I'm not ready to jump in front of the Nike trade. Everybody's been trying to catch that bottom for a long time now and being hurt. Okay, so there we go. That's SMAs. Next, we're going to start talking EMAs. And so what are EMAs? What do they represent? And how can we use them as day traders? EMAs are mostly going to be used on shorter time frames. We're going to talk about some different ones that I use, and we're going to start with, of course, the most common ones. And we're going to discuss how to use them and what's the difference between them and an SMA. So obviously, you can see we have a lot more volatility here. Well, and they're a little bit more jagged. Obviously, the 50 is a little more fluid, but these numbers all represent the same thing. So yeah, very good question. Are they used in conjunction with support and resistance? Absolutely. So last class or last, of my series classes, we were talking support and resistance. So for anybody who doesn't know, I guess I probably should have said this at the beginning, but for the next 8 or so weeks, we are doing kind of my course series. I call it beginner trading. That's probably not the best way to put it. It's just, in my opinion, it's trading essentials, things that you should take note of every single day. And then at the end, after all 8 classes, we're going to do one where we kind of show building a trade plan with everything we've learned. So tonight we're doing EMAs and SMAs. What are they? What do they represent? And what are some different combos? Because what I like, maybe you don't like, and that's fine. But I want people to say, okay, maybe I don't like the 9, 20, and 50 EMA, but maybe I like the 5 and 13, which we're going to get into. But so EMAs, what's their difference from an SMA? They're exponential moving averages. So what that means is they are putting more weight on recent price action. So the common ones everybody uses, 920 and 50, 921 and 50 is what everybody uses. I use the 920 and 50. You will see basically no difference between the 20 and the 21 other than extreme volatility. And so they're doing the same thing. The 9 EMA, which for me is this blue line, orange one is 20, yellow one is 50. The 9 EMA is looking back 9 candles. And it is telling you, again, a similar average to what the SMA is. However, if you're looking at the 9 EMA here, it is looking back 9 candles, but it's putting more weight on the recent candles. So the math is wild. It's got a triangle and stuff in there, we are not going to get into the actual math of how an EMA is calculated. It's not something you need to understand. All you need to understand is that there is more weight put on recent price action, whereas an SMA is, again, just that simple average of all of them. So first one we're going to talk 9, 20, 50. It's a very, very common combo. Most people use it. It's very, they use some form of this. It's very popular for day traders. It works on many time frames. My buddy 1K, he's a great trader. He uses the 9, 20, and 50 on the daily time frame, which is something that I don't really use the EMAs so much on the daily time frame. He does great with it on the daily. For me, I mostly stick to the hourly and under when I'm using the 9, 20, and 50. And so how can we use them as day traders? What do we use? What can they tell us? So some of the main things that I like to watch for, and you're going to notice overlap in all EMAs. It's just all of the combos we're going to talk. There's just small nuances that are a little different. Some of them that I like to look for, crossovers. If you start to see the 9 crossing below the 20, crossing below the 50, there's a good chance you're starting to see a change of trend. If trend is up and they start crossing down, you're likely seeing a change of trend. So how can we use each of these? For me, I don't take many trades off the 50 EMA. I use, and that's this yellow line. It's the longest one. You get the reactions on it a little bit slower. So I like to use it as my trend setter for the day. I'm not necessarily going to take trades off of it. Of course, they do work very well frequently, but if the 50 EMA is kind of pointed down and right or flat, then I'm assuming we're kind of downtrending. If it's pointed up and right, I'm assuming we're kind of uptrending. This is one thing I meant to say this earlier. All EMAs and SMAs in trending markets or ranging markets, sideways movement, almost useless. If all your EMAs are pointed sideways, assume that we are ranging. And if you don't like trading ranges, maybe sit out until we start to develop a trend. But I use the 50 to kind of define my trend for me. The 20 is the one that I frequently like to take trades off. I know a lot of people like to buy the bounces to the 9 EMA. You'll hear it all the time. People trade those 9 EMA bounces all the time. My preference is actually not a bounce to the 9, it's a bounce to the 20. And or whatever it might be. And so we're just looking at charts. I always like to relate it to charts. I like a bounce to the 20 because frequently the 9 will get wicked past. And so if I'm looking to buy the bounce to the 9 EMA, my stop is going to be a close over the 20 EMA. So if I can wait until the 20 EMA to buy it, I'm reducing my risk by a little bit. So that is the main way I'm going to use it. I'm always going to use it in conjunction with support and resistance. Let's see, if I have levels going on, obviously see we're forming a trend. This is what I was trading today. We're below my levels. We don't have a lot of data up here, so I don't have a lot of levels up here. We're below my EMAs. We're setting lower highs. Then I can start to say, I can look to short these bounces up to the 20. So that's what we see here. And I like that again, just because it's a tighter stop. Do 9 EMA bounces work? I mean, yeah, look, if you shorted this 9 EMA, you were happy. If you shorted this 9 EMA, you were happy. Of course, you can get blown out sometimes. Maybe I short this. Well, I'm getting stopped out on one of these next two candles. And if I shorted this, my loss is much larger. So, of course, they can always show you fake outs, but those are the main ways that people are going to use these EMAs. And so, I mean, I guess I can just pull this up and I'll remove these trends because we haven't got to trend class yet. But think of your EMAs as support and resistance that have an angle to it. So we want to use our support and resistance and say, okay, we're below resistance, we're below EMAs, we're obviously setting a downtrend, we're bouncing to the EMAs. I'm looking to short these EMAs, and my target, as always, is the support down. Of course, this chop was a little rough for some people, but ultimately you ended up getting the best sell. So really, really nice for people. Of course, if you're trading same days, if you get, this type of a sale, you want to capitalize on that and do some trimming. If you short one of these and you kind of get this bounce to the higher lows, you of course still want to be trimming, but you can have more confidence that it's going to continue down. So again, that's 9 EMAs. Does everybody get that? So when it's between the EMAs, like this, chop. So remember what I was mentioning earlier? I'm happy you said that. When the EMAs all start going sideways, you are very, very and you could have identified it by around here. You are very, very likely going to start seeing chop. So you can see, these bounces pay nice into end of day. If you're trading 597s, you're printing on any one of these bounces. If you're trading 598s, you're making nothing. Or if you're an SPX out of the money, you're making nothing. But these, I mean, these are 40, 50, 60% bounces on a same day. So there's money to be made as long as your levels line up. But when these are sideways and we're between them, there's a very good chance that the market is ranging. And if you don't like trading ranges, you're going to have a lot of trouble. And we saw it today. A lot of people buying calls here and here and here, looking for those breakouts that never came because it's a range, I mean, ultimately it did come, but if you were in like 598s all the way from back here, you didn't make money here. Maybe you made a couple bucks back by end of day, but that was it. Okay, so that's 9, 20, and 50. Everybody get those? No questions there? Okay, we are good there. So up next, we're going to talk one of my favorite combos. This is one that I use and I actually keep it on a chart basically every single day. And we're going to leave the support and resistance up, as I said. We're going to leave that support and resistance up to cover you to keep mixing all these things together. So this combo right here is the 5, that's the purple one, and the 13, which is the blue one. And what do I use this one for? So personally, how I had always used it until maybe a year or so ago, when Tilio and I were talking one time, and I mentioned the 5 and 13 EMA, and he said, oh, do you ever use that on the daily? And he said he uses it on the daily. And I had never really used it on the daily. I always used it for the short time frames. So we're actually going to talk the short time frame first. And then this is one that nowadays, while I used to only recommend it on short time frames, now I actually do recommend it on the daily as well, after kind of talking with Tilio about it and really going back and looking how it performed. So 513. And again, these are both these are both short period. That's what it's called. The 5 or the 13, that's the period. It's how long does it cover. So these are both short. 5 and 13. You're looking back 5 candles or you're looking back 13 candles. So you're looking back somewhere between 20 minutes to just over an hour is all you're really considering. So how do I use this one? I use it to pick up changes of trend early and potential volatile moves. And so today it actually has a couple of good examples. And I look for crosses. That's the main thing that I look for on the 5 and 13. And there's, of course, again, just to reemphasize it, when the market's going sideways, you're going to cross and you're going to cross and you're going to cross, and it's going to be completely unhelpful. This is one that I like to use to try to catch a volatile move. And how I use this is I look for the cross to form, and it will pick it up before most other EMA combos will. Of course, you can go even shorter periods, but I don't like that. 5 and 13 is about as low as I want to go. Otherwise, you'll start to have a whole bunch of fake outs. So, how I use this and my favorite way to use it is I look for a cross, which we would have identified here. Then I short the very next bounce, no matter where it is. And I know that my stop is just going to be if we start pushing above those EMAs. So, generally, your risk is going to be very low. And then when I'm doing these types of trades, I almost always treat it as a scalp. So I want to hold this for, one, two, maybe three candles. That's all I'm looking for. I'm looking for the volatility of some of the short-term traders having to give up their positions. Bulls were winning really big, and then around here is when they started losing. This is where they started to give up. And it's, of course, not just because this EMA crossed, but it's a great way to identify it. So we get the push down, the bounce back up. I want to be short here. Then I'm going to look for a couple 2, 3 candle volatile move down. And I'm never going to look for much more. In fact, I'm frequently at that point going to look for a bounce to catch a retrace kind of back up to him. Of course, you can again treat these like all other EMAs. Once the trend is established, you can kind of short that higher EMA with a tight stop. That's all you have to do, see if the candle's going to close above it or close right around it, enter there and ride your shorts down. But again, if you short this one, you're looking for maybe 1, 2 volatile candles down. Once you see these buyers show up, you're out. If you do this one again, 1, 2, 3 candles and you're out. You're never looking for much. This is just going to be one that can pick up some volatility early. Here's another cross. Unfortunately, it printed on this candle. And if you did buy this first dip down to it, you made a couple bucks, but ultimately the market ended up chopping and there's nothing that you can really do about that. And so it's one that I use all the time. Again, ranging market crosses are going to be tricky and they aren't going to be very helpful. That's going to be all EMAs. Of course, you can try to catch some of these, but this type of movement tends to really it kills people. They frequently don't do well in that. If you're seeing selling, you're seeing crosses, you can look to buy these dips to it for a couple 1, 2, 3 candles up. Always use them in conjunction with your supports and resistance as well. If we're getting strong buying, we're getting across, we get EMAs curling up, we're breaking above trend and level. This can offer a really, really nice entry for you. So then we can go to the daily, which this is something, let's go to a blank one. This is something that Tilio put me onto. I didn't use him on the daily a lot, but I had glanced at him. But when he brought it up to me, and I mean, this was, gosh, probably a year and a half ago, somewhere around here, he said, this thing is just riding the 5 and 13. I mean, it's riding the 5 and the 13. He's like, this is where I've been buying all my dips, is just on this 13 EMA. And so all of a sudden I realized that it's a really good one when you have a strong trending market to identify those early dip buys. Or, if they're crossing, short those, the early crosses, try to short those crosses again, just looking for, nice volatile move is all. But really, really powerful one on the daily as well. And, you're again going to kind of trade it on the daily the same you would trade it on a shorter time frame. Just ideally some more times on your contract is all. Okay, so that's 5 and 13. Any questions there? Yeah, volume weighted EMAs are cool. For my volume weighted, of course I stick with VWAP, which we will be covering in another lecture later. But yeah, anytime you can get volume involved, you're killing it. I always say, if somebody ever tells you that they don't use volume in their trading, probably don't take a ton of advice from them. I mean, volume speaks, it tells you what is happening in the market, and the market doesn't move without volume. So anytime you can get volume involved, it's good. Chris, so yes, volume speaks volumes, George. I like that. So, Chris, yes. However, you always need to remember that these are not some surefire way you're going to beat the market. They can be wrong. So, or, you can get into some volatility, I mean, just to go back to, let's see, where was that? Uh, this day. So you got across here. If you shorted it, you made some money. Like you did. Like there was, this is a dollar flush. There's money to be made here. But if you aren't the type of person to take that, then you're going to get stopped out over and over and over looking for these moves. So just because a cross comes does not mean that a trend is going to form. But as we cover more and more things, it is a piece of confirmation. You always need to have more than one reason to enter a trade. You can't just say, hey, we've bounced to the 13 EMA, I'm shorting this. You need to look for, support and resistance. Maybe we've sold down. Let's see. And this is hindsight trading again, so maybe we're moving up to here. And this is actually a great example because it's a trade that you realistically could have taken. So we've sold down, strong trend down. Obviously, if you aren't using trend lines, you're kind of missing the trend break, but no big deal. But we've bounced up. These EMAs are kinking, but you short the 13 EMA. That's fine, but all of a sudden it crosses, And so now that it is crossed, you have gotten blown out on this trade. So you always need to take context of the market. And so, yeah, we bounced up to here. However, where would our downside target have been if we wanted to short it? And really, it would have been here. So there's not, you got a 15, 20 cent drop. There's not much meat on the bones. So always take context of the market into account. You can't just say, okay, we've got a cross, I'm shorting this cross and I'm looking for a big move down. If I'm using the 5 and 13, I'm looking for a quick volatile move down. Is this for both longs and shorts? Absolutely. It just depends what way they're pointing. As I said, you could have bought this dip here after the cross, maybe made a couple bucks, but you ultimately got chopped out. Here's one where it worked better. You got the cross, you got the bounce up, you shorted the first bounce up, and ultimately it started to be a really nice short. This one even had a lot more confirmation. We aren't getting too deep into trade plans, but push above to new all-time high, instantly sell below the 600, then get the crossover on those EMAs early. You short this first bounce and your stop is over 600. We actually took this trade today in Pro VC. I sold really quick. I think I sold at this double bottom right here. And we actually shorted it somewhere up here. But I think I sold at this double bottom real quick. Uh, Levels always more important than a crossover, in my opinion. That's just my opinion. Okay, so 513, no more questions there. Next one we're gonna get into, and these next two we'll go through pretty fast. Again, they're all kind of similar. So this is another less used one, but this is one of my favorite combos for day trades. Little longer period, gives you a little bit more information, and is not going to pick up a cross as early, but is going to give you very, very good info to stay in. So maybe you don't want to use this with same days, that kind of thing, but maybe you want to use it on some longer term day trades. Maybe it is a trade that you ultimately get out of pretty quickly, but where I like to use it is on anywhere from the, 15 up to about the hourly. And so what this combo is the 12 is the purple line and the 50, the 12 and the 50. So it is going to pick up crosses a little bit later, but when it picks them up, it can often provide a nice day trade. And so I just had to go back to kind of look for a move that I would have liked. And so I want to identify a cross like this. And these ones, this is actually probably a trade that would have like scared people. And it ultimately ended up chopping. I want to identify the cross. Now, kind of going into the open. Now we kind of have an idea of where we are. I want to be a dip buyer at the first touch of this 50 EMA. I love the 12 and the 50. They pick them up a little bit slower. And then this is 15-minute time frame. You can even go longer, but a pullback on the 15, your first dip after a cross, first bounce even after a cross if you're shorting it, you want to be in here, and then you always want to pair it with some sort of support. So this is actually a really great example of the trade. We get the cross in the pre-market, so we know if we dip back to these, I want to be, I want to be one of those dip buyers, and we're buying the 50 EMA. Our stop is below our closest support. So we get to use both of the things that are important to us, and ultimately you catch a really, really nice move. It's 30 minutes, so it's not a super long day trade or anything like that. And then obviously you should be ratcheting your stops up if you catch the $2, $3 pop. But this 12 and 50 is a great one for confirmation to stay in trades. Again, let's see, I got to get my trend lines out of here. I want to look for any sort of cross, and those are around the times that I want to take the trades. So you can see as we zoom out, they don't show up frequently. And I think that's good because people tend to go looking for trades. You want to be able to identify some nice, obvious crossovers. Oh, that one doesn't even count. Oh, here we go. So, oh, I think I actually took this trade even using these. So obviously this was election day. So we had the big strong, we had the strong, we had the strong crossover. This was a great dip buy. Obviously, it was risky enough going into election day. However, that next morning after elections, we had a giant move up, whatever it was, $15 move up or something, maybe even more, $13 move up. How do you buy the dip on this? You look for a pullback to these EMAs, and you can see we get a pullback here. We get a pullback here. Our stops are around this 586 level. Ultimately leads us to a bounce. Well, now we're in this trade. We've caught this nice ride up, and so maybe we want to swing some of the position. I'm not saying you should, and of course, this is another massive move. I mean, I'm not saying you should swing on this, but we've got the cross, we've got the retest to confirm it. So you can stick with that trade. Your day trade can turn into a swing. And then ultimately, if it wants to keep going, you stick with that trade. No issues there. And then, I mean, you shouldn't swing. You've caught a $13 move. Stop swinging at that point, but you can use, God, I mean, that one was just insane. That probably wasn't the best example just because it worked too good. This could be your stop. I guess one of these could be your stop. This is kind of your first pullback. You've caught an absolutely massive move. This could be your stop right here. You get some closes under there. That's where you're saying, okay, I'm calling it quits on this trade. But a very great longer term trend identifier. So 1250 daily, day trades more than anything. Not so much for scalps. I don't love it for the crossovers or anything like that on shorter time frames. But great one for your day trades and telling you, should I stick with the trade? Any questions? Okay, up next, this one, again, less commonly used, but it's one that I love to use for swing trading. So I'm going to be using this one hourly, 4 hours, any hourly, 2 hour, 4 hour, any of those longer term ones. This is something that I love. And it's again, one that I use for crossovers. I want to catch the crossover, and you'll frequently have to run a slightly wider stop because you need to give the trade room to breathe. That's the thing with swing trades. We all want to have the best entry that we can, but sometimes sometimes the trade has to go down 15% or whatever it is, on a swing trade. I think if you're seeing 20, 25, 30% frequently on your swing trades, your entries likely need some work. But I use this 1334. Again, so we got blue 113, purple 134 for sticking with trades. if I'm in a trade and I'm saying, God, I'm up, do I want to swing this? Because most people, I trade my scalps in VC, so that's what most people know about me. But I swing trade every single day. This is one I use all the time for swing trading. So something that I might look for, and of course, we get to do a little bit of hindsight trading. We're having a daily close below these hourly 13 and 34s. I might start to look into a swing trade here, especially if we're giving them both up. We have resistance overhead. I know that chances are I'm not going to get blown out by more than a buck or two. And if you're swing trading, you should have time on your contracts. So I'm not going to get blown out by more than a buck or two. Worst case, we go to these highs and I'll stop out there the next day. But this is one that you can look for. And then you catch the really nice move. We're going to ignore these numbers, but you know how big this move is? These EMAs, slower moving, not going to be volatile. You're going to be able to just ride these trades. When you finally get the close above it, you take the stop out. Ultimately, you could have made more money, but it offered you a very nice entry end of day for a nice little swing. And so then again, I just kind of watch them. Something like this is kind of the exact opposite way. We've broken above it. We're now pulling back and retesting it. I likely would have been a dip buyer right here. Crossover, first test of it. Then strong enough close that I'm probably looking for the swing, and ultimately you get a little bit of a gap up, couple of bucks, $1.50 gap up, whatever it is. Nice little move right there. And then maybe you get blown out. I would have been stopping because if you bought this, you got the $4 move up. So I would have ratcheted the stop up to somewhere around here and just rode it. Nice little swing trade, identifier. Yeah, this one's rough. Here's a nice, but this is probably getting into like elections or something. Yeah, that's got to be getting into elections or something like that. But use it for your swing trades. Use it for your confirmations to stay. Maybe you're swinging long. You're staying well above it. You're retesting it. You're looking good till this day. Then you get clobbered. No real entries here. I would have liked to bounce to, a little bit higher up. Maybe this bounce here, staying short, push up to it, swing short through that next day. Maybe this is actually getting to carry trade time. So relatively unhelpful, because you can't pretend like the news is coming because of EMAs. But swing trading. So any questions there? As I said, we can get through these last ones because they're fast. God, there's a nice crossover entry there. Okay, and so very final one we're going to talk about. This is one that I use all the time. I use it every single day in my trading. We'll actually get much more into this one in a later class as well, but it is the hourly 20 EMA. So if you ever see in my tab or see me posting charts and you see this really ugly stair-steppy thing. So this is the hourly 20 identified on the 5-minute chart. So how do I use the hourly 20? I use it for my bias. As long as we aren't blown out way above it, if we're just kind of riding it up, I'm a dip buyer at the hourly 20. Yesterday was a great day, or whenever this day was. Great day to be a dip buyer at the hourly 20 for scalps. I use it all the time. If I am long and we start, I'll buy these double bottoms at the hourly 20. I love it. If I'm long and we start to sell below it, have some candles below it, I'm no longer long. It is my main bias builder for the day. I typically use VWAP and hourly 20 together, but it is my main bias builder for the day. And if we're above it, obviously when we're way blown out, I'm not looking to buy dips right away. But if we're above it, I'm a dip buyer. If we're below it, I'm a bounce shorter. I keep it very, very cut and dry on that one. It's just really the no-brainer. I use it, like I said, all the time. I use it in my trading every single day. We'll get into it a little bit more and more, but this is one, if I had to pick any indicator for somebody to use intraday, it is very likely going to be this hourly 20. You can trade around it every single day. It provides great dip buy opportunities. Obviously, breaks and retests, love it. Maybe if you were short, when it's going sideways again, like all the EMA is very, very unhelpful, but run this hourly 20. It's of all indicators, I think it is one of the most powerful ones. There's a bunch of us, in here who use it. And not only can we short break and retests of it. If we're dip buyers, it is always the target. If we've broken below and we say, okay, the market has sold plenty, we're reclaiming some supports, you target your supports, it will frequently be a target because you have to figure all of the short-term traders, that's where their bias is going to kind of be changing, it's covering the last 20 hours. So basically, the last day. And if we're breaking below it, bulls are giving up. If we're breaking above it, bears are giving up. So trade this thing all the time. So any questions there? As I said, we'll get more into hourly 20, but this is one that I really, highly recommend everybody uses it on all of their charts every single day if they can. Okay, any questions? If not, we got 5 or so more minutes. We can of course check out charts. There's Norvin already uh there's Norvin already asking for charts, of course. What are my Bollinger Bands set to? So when I use them, second, so hideous, I know. I almost always use them with the VWAP. When I use them, I typically do a -2.2 and a -3.3. If it's too ugly for you, which I get, do a 2.5 because if you do the 2.5, you get to ignore the or you don't have to see as many ugly squiggles on the chart, and that it's going to be stronger than the 2. It's not going to be quite as strong as the 3, but when you can use those extensions outside of it to start to, maybe buy some dips for a scalp or whatever it may be. But if, like I said, if they're too ugly for you, then a really great way to use them is short those extension or whatever, short an extension, long an extension, and then your stops, how I always treat them, like if I short this, then my stop is going to be wherever the B band is on the next candle up. So if I'm short here, I'm stopping somewhere up here, wherever it ends up printing. And you're really only looking for scalps off of those things, but provide some great dip by scalps, great short opportunities basically every single day. Yeah, love the double bottom entry on them. So on that double bottom setup, and again, this is not, this has nothing to do with the class we're talking. These are just questions at the end. Uh, on that double bottom setup, or any of those, I like to have both of them running. I have a chart where I almost always have the 2 and 3 running. Let me see if I can find an example where it works. Well, so this is kind of a second. Um, so this one may not be the best example because it also kind of it is a higher low, so maybe it's not the best double bottom example, but I frequently look for the double bottom higher low more than just the straight double bottom. But what you want to see is extension, and then you want to see is pushing down to lows, and you don't extend. You don't want to push outside of the B band. That was a Bollinger idea, was you want your first bottom, and he called them W bottoms, is what he actually referred to it as. But you want your first bottom outside of it. You don't want your second bottom outside of it. Can also be used on double tops. You want your first or your first top outside of it. You want your second top not outside of it. So when Bollinger's identifying them, he's frequently looking for the lower highs double top or the higher low double bottom. Oh yeah, ACHR. I saw that. I saw that one. Everybody was talking about that. That's just a Twitter name right now. Let's see. So it looks like just Norvin questions. RGTI. Why not, Norvin? Let's see what we got. No, this is useless. What do you want? What do you want me to say about this? I mean, the thing's up. The thing was up 92% over to highs. So you missed it. And then intraday, it was down 30% off highs. So yeah, there's really nothing to talk about here. Bank of America, thank you. Yeah, let's check something real out. This is one. Oh man, well, you can already see where my levels were. Give me 1 second. I mean, you can already see where my levels were on BAC. That break of 47, I had been eyeing that one. I wanted that. I apparently missed it. I know I had an alert set there, but I didn't get it. Above here, 47. You're, you're looking good. Are you in this? Are you in this trade, or is it a trade you're looking to get into? Because I mean, over 47. I mean, I like a dip buy down to 47. Push to 47.96 again above there. Pushed out 40. I mean, always watch 48, of course. 47.96, 48, and then above that, my next would be 48.72, and then push to that 50. See if we can get that move back up. You'd have some minor resistance 49.50, but this thing wants to keep going. Definitely a place to focus on for the next few years is financials. They should perform well, in my opinion. Looking to get in long. So if you're looking to get in long, I'd try to catch that dip down to 47 if you can. That would be the ideal. And then really, this is the type of trade where if I did get in there, I would widen this stop down. If you're taking the dip buy to 47, you do need to be prepared to see a little bit of red. I'm a dip buyer all the way down really to 46. Then if we start to break that, you can look to stop out. Don't turn bearish, but look to exit the trade just because you were incorrect this time. No big deal. SPY, yeah, we can talk SPY. So SPY, obviously, very little data in this area. We knew basically the one level that mattered today was 600. We wanted to have our eyes. I mean that whatever 617, whatever it was, that was the level we cared about. If we couldn't sustain above there, you should have had basically no interest in being long. However, we're in this kind of tricky situation where we've made a really massive move and we don't have much data up here. So finding levels, I'm finding them on the 4 hour. As most people know, I find a lot of my levels on the daily. They're stronger. They work over and over, so I stick with them. But for levels that I would be watching around here, you just always want to identify any of those major highs, major lows, because it's all we have to trade around. So this is kind of what I'll be watching on SPY. Obviously, I think, oh yeah, that 595 is giant. That one needs to be on there. So obviously, you should be bullish on SPY. There's no reason to be bearish on SPY. However, you don't necessarily want to be getting long and strong and swinging long this close to 600. I today, what I was actually watching was I really wanted this dip by down here to this, like, I wanted them to wick us under 595 so that we could have bought that dip into the close, but didn't get that today. But for me, this 595 will remain that dip buy zone. If we get below there, you can definitely look for some, maybe shorts down to 594. Maybe we want to go see this 592, 593 area. Otherwise, I'll just be looking at basically these same levels. Any breaks above, I'll be dip buying up to here. If we aren't going to pass it, I'll be looking to short it. But for SPY, for me, definitely bullish in the short term. But I would like to see I would like to see some pullback. Maybe it comes this week, maybe it comes next week. I'd like to see a little bit of pullback to maybe get a dip buy for that last couple of weeks of December. But I'm long and strong and staying buying dips. As long as we're above basically 590, no reason to not be bullish. CELH, and that'll probably be the last one. The old Celsius, still just getting smoked. Ooh, wow, getting down there, huh? Hard to say here. I mean, probably trying to fit in a little break. You can already see the levels I care about around here. I mean, I don't love it. Horrible chart, but if you want to do some bottom fishing, it's kind of the time to try on them. Most breakouts fail, but a dip down to here, this 28.85 stops below trend in 28. Honestly, a pretty dang decent trade. Not too bad. Okay, well, if that's gonna do it, we will call it a night here. Thank you all so much. I appreciate you for being here. We'll keep this series going. We had a nice little turnout tonight. I didn't think there'd be too many of us Thanksgiving week, so thank you all for being here. Talking EMAs, SMAs again. If you want any of my info on any of those combos, or just a reminder of what the combos are and how I use them, let me know, and then play with them. As I said, maybe you don't like the 920/50, maybe any of that, then try out the 513, try out some of those other combos. There's a million combos of EMAs out there, and if you don't like any of them, play with them till you find some that really fit your trading style. And let me know how it's going. As always, DM's always open, and thank you for being here, everybody. Have a great rest of your night. We will catch you all tomorrow. Thank you all so much. I appreciate it. Nah, I'm nothing special. You all can do this too. No big deal. But thank you, everybody. We'll talk to you tomorrow. Have a great night.